24 after 1. We're going to go ahead and get started. Good afternoon. I'm Alan Smith, President and CEO of One Spartanburg, Inc. And this week is National Small Business Week. And today, I want to welcome all of you to our first Small Business Success Symposium, All in Your Business. We're glad you've joined us as we're here to celebrate and support the real backbone of our community, the real backbone of Spartanburg County, and that is small businesses. And advocating for you, we've seen the challenges you've had to face this past year, and to support you, we've been working tirelessly to ensure you have the resources you need to succeed. And so that's one of the many reasons why we are here today. We're especially grateful to Truist Bank for being our lead sponsor, starting off the day with the first session about accessing capital in the time of COVID, challenges and opportunities. Then next, you'll hear how to improve your online presence. And finally, ending the symposium with the All in Your Business panel, featuring some of our most resilient business owners, offering advice and tips to help you move forward in your business successfully. So today, we hope you'll not only gain knowledge, but also be provided with step-by-step actions to improve the way you do your business. So basically, we want to provide you the tools, equip you with information so you can have the strongest business possible. So let's get started. I want to turn it over to John Kimbrell, our Chief Business Affairs Officer, to officially kick off the day. But before I do, I just want to recognize him. I want to recognize his leadership. I want to recognize the fact that going back to April of 2020, he stepped forward, he volunteered to lead our Bring Back the Bird business recovery effort. And a lot of the programs and the initiatives have been very successful, data-driven, results-oriented, nationally recognized. So we're fortunate to have his influence on that effort and fortunate to have him on our team. So with that, I'm going to turn it over to John Kimbrell.
Yeah. Well, great. Thank you, Alan, and happy Small Business Week to you and everyone on the call. As Alan mentioned, this is a week that we always set aside and say thank you for your investment in our community. So happy Small Business Week. Alan mentioned we have three important topics that we're going to cover today. We talked about bringing back the Berg. We heard from our business community. Accessing capital was a big deal. And so we know this first session is very timely. It's timely even before COVID-19, but especially post-COVID-19 is even more timely. So I want to thank Truist, Matt and Wes, and the team at Truist for sponsoring today's session. All these sessions today will be recorded. So if you miss something, we'll make sure that we get the recording to you. There's going to be a lot of information shared. We don't expect you to take it all in on this call. So if you have any questions during the call, please go to chat, answer that questions, and we'll make sure that those are answered by the appropriate person. So I want to thank Truist Bank, also SBA and Community Works. Community Works has been a partner with One Spartanburg, Inc. over the last year when it comes to our COVID resources. And so we want to thank them for joining us as well. So I'm going to turn it over to Wes Lair with Truist Bank, and everybody's going to introduce themselves. And then we'll turn it over to Wes to kick off the conversation. So Wes, thank you for joining us.
All right. Yeah, happy to be on. Thank you for having us, and thank you for allowing us the opportunity to sponsor. I'm Wes Lair. I'm our market president in Spartanburg, Cherokee, and Union counties. I've been with the bank for about 10 years on the legacy BB&T side. And just for you, those of you that may not know, Truist is the merger of BB&T and SunTrust.
Thank you, Wes. Michael Hughes.
Hey guys, thanks for having me today. I'm actually our SBA expert for the Carolinas for Truist Bank. I am Heritage SunTrust, since we do say Heritage Banks, because you will find slight differences as we still work through the merger. And for our clients, thank you for working through that with us. I've been doing SBA for nearly a decade now. I've been with the Heritage Institution of SunTrust, now Truist, for about 12 years. And before that, I was actually at Clemson University. So for a millennial, I'm actually a lifer, which is kind of funny. You don't see that much, but that's who I am. I've helped put over $1.5 billion of SBA assets on the books here at Truist. So if you have SBA questions, let me know. We'll have a chat later.
Great. Thank you. Thank you for joining us. And also we have Paul Schmidt for Community Works. Paul?
Hey, good afternoon, everyone. I am Paul Schmidt. I'm the Director of Lending here at Community Works. You'll hear more about who we are during the presentation, but personally, I've been in the upstate since the early 80s, working as a commercial bank for various institutions, most of them which have changed the names, so you would not remember all of them. But I'm very excited to be here with Community Works. I've been here about 2 years, the end of this month, and look forward to being able to show you some of the programs we have and to talk to you a little bit about the Back to Bird program that we are an integral part of. So thanks for having me.
Great. Thank you, Paul. And I think that's going to be all three of our panelists this afternoon. So to kick things off, I'm going to turn it back over to Wes with Truist Bank. Wes didn't tell you, but Wes is also the board chair of One Spartanburg, Inc. So we certainly appreciate all he does for us, his strong leadership as our board chair. So Wes, thank you for your leadership and thank you for joining us today. And I'll turn it over to you.
Well, and before Wes goes, let me say, John recognized my boss before I did, so I hope that didn't get me in trouble. But I do want to speak to the fact that, Truist is a great partner in terms of, financially supporting our work, but also in extending the time to Wes to give to this organization. And he has given a lot of time to this organization. So we certainly appreciate his insight and his influence over what we've been able to do since he began as chair July 1 of 2019, right, Wes?
That's right.
Which seems that 2 years might as well be 20. But we really appreciate having Wes lead our organization. And so with that, we'll turn it over to him.
Well, thank you. And it's a great partnership. It's been enjoyable to see the progress and just the team coming together at One Spartanburg. So the pleasure is all mine. And I'm wrapping up that role June 30th. So on the tail end. Well, I'll touch a little bit on Truist again, and then I'm going to be talking on more of the conventional side of capital, particularly debt capital. So mine may be the more mundane blocking and tackling when it comes to debt, but we'll save some of the more exciting options and forgiveness options and some of those kind of things for later on in the presentation. I know Paul's got some of those to cover. So first off, really first slide, if you go to the next slide, is our mission, vision, and purpose. And really what I wanted to start with this because we really use this each and every week, each and every day to drive our actions, drive how we interact with clients. And it's not just put up on a wall, but it's really something we live by. And if we can take care of our clients, they're going to take care of our communities. And at the end of the day, the bank grows and it's actually more profitable and less risk to us. So it's a full circle. And we really, truly mean the fact that we've got to take care of the businesses and the people within our communities for that circle to start and go around. As I said before, just Truist-wise, we combine branch-wise, we're sitting at about 16 branches across the Piedmont area. And so you'll see our signs out there. They're still SunTrust BB&T, but later this year, they'll become Truist. So from a capital standpoint, you can see in this slide, the top right-hand corner is what we're really going to talk about today and what I'm going to cover, which includes loans, leases, credit cards. SBA is going to be the second part. And we won't get into too much on the new market tax credit side. Those are for much larger transactions. But I wanted to start with this slide for everyone to see that capital is just really one piece of a business owner's needs and what they have to think about and to focus on. So we do all these other buckets from advisory services, employee benefits, of course, personal banking, payment solutions, and then insurance or risk management. So a holistic approach is really what it takes for a banking relationship and the client to have a successful partnership. But I know a lot of people, and even myself, can go right into the loan side and how much can I borrow? How much debt can I have? And that's obviously needed to grow the business. So just wanted to give that overlay. This is highlighting some of our industry specialty and advisory. A lot of these buckets get more applicable the larger scale business you have. Typically, I would say it's in businesses that are maybe 5 million and up in sales revenue. Although there's always going to be some outliers and some special circumstances. An example of that is SBA that we're going to talk on, that it can go much lower than that. And I also say, as you'll see in some of the future slides, the capital structures that I put together are more of a customary, typical scenario. But there are plenty of times that we're playing on each end of the spectrum and getting outside the lines. And particularly, we can do that in some of these industry specific spaces that we follow. And it's just because we understand that business a little bit better, or understand that industry a little bit better, which in turn reduces some risk and then allows us to maybe be a little bit more aggressive on structure or pricing or terms. So again, this is a typical business that we see and that we strive to work with. Again, there can be things that fall outside of this, and there can be special circumstances that maybe you're taking over a long-term business versus it not, you maybe not have not owned it for 2 years. But typically we see clients that have 2 years of operations that we can have some financial based on those 2 years. This is pretty basic, but we want profitable businesses. You got to make money in order to repay debt and to keep our risk tolerance where it needs to be. And you got to think, you'll see a little later on too, we're putting debt out there, and that if everything goes perfectly as planned, we're getting paid back anywhere between 2 to maybe 5% on the high side in an interest rate. And so those are pretty thin margins, and those are obviously gross margins. So after you pay to keep the lights on, pay the staff, real estate costs, et cetera, that net margin is pretty small. So the banks, the businesses that we lend to have to be a pretty low risk profile. And so profitable is obviously a key factor of that. Growing or consistent revenue, usually if you're going to be borrowing, it fits with a growing company. They're typically personally owned and operated. We can bank folks that are passive investors, but typically we like seeing the business owner heavily involved, and usually that's at a majority ownership level. There may be 2, 3, 4 different partners that it's sliced up, but like to see the business owners involved. And then you'll see in some of these ratios, I think it's my last slide, that cash flow, liquidity, equity, and there can be different combinations for different industries, but those are things we need to see to get aggressive and to be able to lend in that business. So getting started after that, typically if we engage with someone, these are the basic items that we're going to want on the front end to understand if we have a good client fit or not. And so I'll roll through these quickly, but on the personal side, a personal financial statement, we've got forms. If you need a copy of a form, if you have your own, you can use your own, but just understanding basically the balance sheet of your personal situation. 2 to 3 years tax returns, 2 at a minimum. And then we really like to get all K1s that are accompanied with that. And K1s really show the cash flow that comes from any investments or S-corp businesses or partnerships that are outside of your personal tax return. Even though they flow through to the personal return, the K1s will show us the movement of cash or the injection of cash. On the business side, We like to get tax returns to match those same periods. Also have some company prepared balance sheets and income statements. Sometimes a tax basis versus a accrual basis on some of the company prepared financials can be a little bit different. And so it's good to reconcile those two. And quite frankly, for a lot of the business owner and for the banker, it can be easier to follow and track and compare year to year over the company prepared financials. A debt schedule. This is a pretty simple Excel spreadsheet, but showing all the debt that you have, the payment terms. Typically, you'll put in the interest rate, maturity, and that helps us calculate the true debt service coverage ratio, which is probably the most important ratio that we look at. We can get into some accounts receivable, accounts payable, and inventory reports. If lines of credit get up, maybe $1 million or higher in the line size, where we want to see some of those collateral pieces and the assets that back that line of credit. And the last component here, and this is something obviously that's new to us, but we do want to have some commentary, and we fill out some internal forms on this. And then it also we're going to have some commentary with our business owners on any kind of projections, but also one-time hits or items during COVID that threw the financials off. Because most businesses that we've seen have went one direction or the other with COVID. Most have not just stayed the same. And so really understanding what it has done in the past to your business and then what it's going to do going forward. Another component of that, I didn't put it on here, but PPP is another big part. Most of our clients receive PPP at least first round, but I would say even a good portion in the second round as well. But want to get an update of where that is from a forgiveness standpoint. All right, here's basic buckets of financing. I've tried to break them down pretty simplistically, but you can see the different ranges from amortization and loan to values and so forth. But I'll roll through these pretty quickly. But on the real estate side, there's really two main buckets. You have owner occupied real estate, which is basically the building or buildings that your business operates. And from there, the second component is investment real estate. Sorry, I was getting a phone call on my iPad. All right. So investment real estate is where your business does not occupy that real estate and you lease that property out to someone else. So the differentiator, owner occupied, is usually a little bit less risk to the bank, and therefore we can get a little bit more aggressive because you're there day to day, you're invested, you're making sure that business is going to be successful. So we can get up to 85% loan to value, loan to cost. We like to see usually the lower of the two of that. Construction may be a hair under that. That's why I put a couple of those ranges. And then if the business is a little bit newer or there's been erratic cash flow, we may go a little bit below that 85% level. 20-year amortizations, we can actually get to 25 on some asset classes. I didn't want to put that in this slide just because it is some usually new construction or a couple of special circumstances, but up to 20 years is pretty typical. And then balloons, that's really the rate period that's fixed if you choose to do a fixed rate. So 5 to 10 years. And that's just all personal preference. Right now, the yield curve is a pretty typical yield curve to where it is increasing, and a 5-year rate may be 1% less than a 10-year rate. So you can kind of weigh your options of how long you want that fixed in, knowing exactly what your payment is. Pricing can be prime. SOFR is actually the new term and the new index that's going to be replacing LIBOR later this year. Most people should be transitioning to that. I think LIBOR doesn't actually completely go away until 2023. But we can float off those rates, or we can do a bank fixed rate. I did put in here swaps are an option if you want to do it. Basically, it's an interest rate derivative that basically you have a floating rate at the bank, but we overlay a contract that basically makes that a fixed rate for you. And I won't get into too much details there, but it's basically an indicative fixed rate. Ranges rate-wise, and I put pretty much this in on all the things, but depending on floating versus fixed, and depending on, it's really the credit quality of your business. 2.5, I would say, is on the low end to 5% on the high end, with most people probably borrowing in between that 3 to 4, 3 to 4.25 range. Investment real estate's pretty similar, but we can back those loan to values down a little bit just because it is sheerly lease driven. You have that building being leased to somebody else, and so that's got a little bit more risk to it. So we want to have a little bit more cushion on the investment real estate side. But we're in the business of both. Term debt. This is typically your equipment, rolling stock. I won't go into all the buckets on here, but we can actually do up to 100% financing. Have some programs, especially for the rolling stock vehicles, trucks. 100% financing can be pretty typical. 5 years is I would say very standard. Can get up to 7 if it's the right asset that has that useful life of something that long. Unsecured is going to be a little bit less. You can see the 3 to 5 years. We typically won't, because there's really no collateral, that the cash flow has to pay that back. And it's hard to predict cash flow really much out 3 years, but definitely no more than 5 years. So but we do some unsecured lending or unsecured lending, but those are the typical ranges. Lines of credit used for working capital. Usually it's pretty soft secured. I would say in the 12 to 24 months, depending on the history of having a line, the history of using the line correctly. But the more stable companies and the more equity a company has, the longer we can do a line of credit. We actually can go a little bit longer than 24 for the strongest of companies. Last is a little bit of a catch-all bucket, and I tried to tier this a little bit more to the small business segment. But personal home equity lines, we see that especially on the front end of getting a business going, or maybe in that first year or two of financing a business, using equity in your home. And it's usually one of the cheapest or most effective ways to access some capital for your business. If you have a stock portfolio, that's another easy way to access capital. The portfolio can still be invested in all its assets and still keep earning and keep the same stocks that you have, but we can put a line of credit against that. The only thing it would prevent you from doing is cashing out everything and just closing the account. You can still trade stocks back and forth and up and down, but that's something that obviously is appropriately secured and a good collateral for us. Last is credit cards. I'll preface to say, just with credit cards, you don't want to rack up a bunch of credit card debt, but they're handy in working capital and delaying payments 30 to 45 days. And on a new business, we do those for new businesses. A lot of that is based off of your credit score, your personal credit score, and your personal credit. And then on the business side, obviously we do it for businesses, and you can get cards from $25,000 to we actually will do cards for a couple $1 million for a large business. All right. In the sake of time, I'm not going to dive into this too much here, but these are just some key financial ratios we look at in assessing a business. And I would challenge you to do these for your own business. Some of these are redundant, but I'll underline the 3 primary ones to really focus on. Debt service coverage, that is the cash flow generated that's available to service debt. So cash flow over debt. Leverage is the other underline. That is basically how much equity is in your business compared to what you owe. Total liabilities over equity or net worth. The lower the better in that category. I think most of our businesses are 4 times or under, and like to see it about 1. And the last is profitability. And as I mentioned on that a couple slides back, you need to be in a business and an industry that can make money. And I would say the low end, 5% of net income to gross sales, and we like to see that up even closer to 10%. And all industries vary in that, but just a good rule of thumb. That's all I have, and I've probably taken a little bit more time than I should have, but we'll open up for some questions at the very end. So I'm going to turn it over to Michael Hughes to touch on some SBA overlay.
Are you muted? I think you're muted. I cannot hear you. Paul, could you go ahead and get started?
Yes, you hear me okay?
Yes.
All right,
Let me.
I'll go ahead and share my screen when you tell me to.
Go ahead. That'll be fine.
Okay, good afternoon, everybody. As we talked earlier, my name is Paul Schmidt and I work with Community Works over here in Greenville, but we do a lot of work in Spartanburg. In fact, I'm a Spartanburg somewhat native since my early days, and so we're very excited to be here today. Just a little bit of background of who we are. We say that we are building brighter futures for under-resourced families and communities across South Carolina. Community Works, we are a nonprofit CDFI, Community Development Financial Institution, and we're committed to building financial equity by providing resources that support small business growth, entrepreneurship, affordable housing, and home ownership. And collectively, our programs, expertise, and partnerships help build stronger and more just communities. The areas of investment where we like to invest the dollars that we have are in the area of affordable housing and community loans, micro and small business loans, and then consumer loans in partnership with the Self-Help Credit Union. Now, here are some of the lending products that we offer. We're going to focus more on the small business, but we want to give you an overview of all the programs that we have. For affordable housing and community facilities, we have loans up to $750,000. And these include acquisition, short-term bridge financing, development, construction, and the preservation of affordable housing. And that is one of our goals, is to see that the markets that we serve, that our dollars can go to help, whether we're a small piece in a large project or we're helping somebody renovate a couple of homes to offer as affordable homes. that's an area that we are very strong in. On community loans, these are loans up to $250,000 for short-term bridge loans and working capital to community and nonprofit organizations and other financing needs to improve nonprofit capacity and community revitalization. So where it doesn't necessarily impact it on the housing side, but what can we do to improve the communities that we serve? Microloans, these are small business loans that range from $5,000 to $50,000, and they support both existing and startup small and micro businesses. Currently, startups are limited to $5,000 and under. And then we have small business loans ranging from $50,000 to $250,000 that support both existing and startup small and micro businesses. And we do these loans through our relationship with the SBA, as we're known as a community advantage lender. So it's under the SBA 7A program, but it's a little bit lower documentation requirements. And then consumer loans from $5,000 to $12,000 through our partnership with the Self-Help Credit Union. But what I wanted to focus on today are the small business loan programs. Our express loans that are up to $5,000 are typically used for working capital and equipment. Where we find that these loans are very successful is if you, one of the areas that we've had a lot of activity in the 2 years I've been here is if you have someone who's working in a salon and they decide they want to go out on their own, they locate a space, and then with the $5,000 loan, they'll be able to purchase a couple chairs, the shampoo bowls, the initial inventory that you need, your hair care products, your first and last month's rent, some of the upfits to the area. So anything that we can do to help get that business off the ground. Now, typically, if you are a startup, we do require that there be a secondary source of repayment other than the business. The business can't be the sole source of repayment. So typically where these are work is where someone is starting a business somewhat on the side, and they still work their day job. A lot of times that would be, we have people that work at BMW, people that work at Michelin, other people that work around the counties. But the idea there is that even though it doesn't sound like much of a loan, number one, it avoids you having to go get it off of a credit card. And number two, I personally was very surprised with what you can do with $5,000 when you're trying to start a business. Then we have our microloans, and these are loans from $5,000 to $50,000. There's a little bit more of a requirement of underwriting on these, underwriting being the documentation you need to present to us and the things that we look at. Where we are different from the banks and where we fit in is the banks do what they do and they do it very well, but sometimes for whatever reason, if they're unable to assist you, that's where we come in. We are trying to avoid people going to payday lenders and to other extremely high interest rate type lenders. And so where we fit into the equation is that, our rates are slightly higher than banks' rates are, but we're willing to take on a little bit more credit risk. If you, for instance, if you've had some credit issues and you go to a bank and you don't meet a minimum score, typically you can be turned down. We take it a little bit deeper. We spend time with you figuring out what the factors are that caused the situation with the credit, where you are now versus maybe where you were a year or two ago. We're more concerned with where you are and where you're going than where you've been. And one of the things that we have is we have a network that's set up to have financial coaching. We have a full-time staff member who can sit down with you and take apart your credit report and your personal financial statement and show you where you are, help you set goals to where you want to go and how you can get there. Somewhat similar to credit repair, but not solely credit repair. We also, on our express and microloans, we offer ongoing coaching. So at your closing, we will have a coach who will spend time with you, getting to know you, follow up in 30 days, and then at least once a quarter, they will meet with you to see how your business is going, to see what they can offer you. How's your bookkeeping looking? Can we give you some assistance on your bookkeeping and things like that? So to me, that was is one of the strongest things about us in this area is that we are determined to get capital into the hands of folks who typically have not been able to get the capital. And these are some of the ways we found to do that. The community advantage loans, these are loans up to $250,000. Again, as I stated before, they are under the Small Business Administration 7A program. The requirements here are stricter. It does have to meet the underwriting requirements of the SBA. They have the approval on those, but we are looking for a way to grow our expertise on this, and we hope that there are those out there that will come to us and we can look at doing some loans in this range. The Paycheck Protection Program, you're probably familiar with it. If you haven't gotten a Paycheck Protection loan yourself, then I would suggest that you reach out to us or to your bank or to someone to find out if you qualify. If you got one last year and you want to know whether you qualify this year, we'll be glad to help you with that. But this has been an area that's been very successful for us. We did a couple hundred loans last year. We've done more than that this year. We're continuing to accept applications through about May 26th, we believe, because the cutoff is going to be May 31st. So you can see there's a website there of how to apply through us. But again, we'd be more than happy to help you with the Paycheck Protection loan. And then there's Bringing Back the Burg. This is the program in conjunction with One Spartanburg that John was alluding to earlier. If you are in Spartanburg County, in the city of Spartanburg, there are loans available up to $10,000, and it's a grant/loan. If you meet certain parameters, you can have up to half of it forgiven. The other half will be repaid at a low interest rate over a 2-year period. So we've been working on those for about a year. And we're continuing to take applications on those. So if you're interested in that, please contact One Spartanburg or contact us. We'll be glad to help you with that also. One of the things I want to talk to you about is preparing for a loan application. I think the hardest thing is when you're going to a bank is, number one, you're nervous. Number two, you're inexperienced. And you're trying to figure out, I got to go in here and I got to show them everything I have, and I've got to impress them and show them, that I know what I'm doing. And so here's some common things I just wanted to share with you. A lack of preparedness and a lack of full understanding of your business are two reasons that your loan request may be turned down. If you can't explain what it is you're doing and how you're going to do it and where it's going to take you, then it's difficult for us to be able to help you, because we have to know that you know where you're going. We need to understand that you know your business from top to bottom. Okay, you may know how to cook, you may know how to style hair, you may know how to fix HVAC systems, but we also want to know that you understand how to run your business and as Wes spoke, to ensure that you can do it profitably, because your profits is what's going to repay your loans. In order to show us that you're a good credit risk, you need to be able to show that you have a firm grasp of where you are and where you're going. Remember, you are asking the lender to be your investor in your business, so you need to gain their confidence they will be repaid. And I want to emphasize that. Any lender you deal with, whether it's us or a bank, that is your investor. That is someone that is putting capital into your business and expects some kind of return and some kind of responsibility on your behalf. The type of things that we look for in general, number one is a business plan, and we're going to talk about that more in detail in a moment. Number two is be prepared to do projections for a couple of years. Projections being, what do you think the next 2 years are going to look like in terms of your income and your expenses, so that we can project whether or not you're going to be able to service the loan and make the loan payments. 2 years business financials and tax returns, that can be 3 years on the SBA loan. Personal financial statement and 2 years personal tax returns. If you are a single member LLC, you're a sole proprietor, you will be personally guaranteeing the loan. So you need to understand that just because you set up an LLC and you get some of the protection of that, it doesn't mean that you won't be personally responsible. And in case of the small startup loans, we're going to be relying on your personal assets and your personal income to repay the loan. So that is why that is going to be a requirement of at least 2 years on that. The detail of the uses of the requested funds, it's not Like you go to the bank and say, I want a $5,000 personal loan, and then they give you $5,000 and you maybe do some car repair and do this, this, and that. In this case, we want to know exactly what you're going to use the loans funds for. Are you buying equipment? Are you doing some marketing? Buying Facebook ads, something like that. And then a detail of the sources needed to fund your request, because typically we're not going to be the only funding source. You're going to have other funding sources. You may have other loans that you've got. You may have other investors that you have. You may have your cash equity that you're putting in. And then a list of the collateral offered for the loan. I won't speak specifically to collateral today, but the collateral is what you put up for the loan, that if the loan does not get repaid in a timely manner, the collateral could be sold and the loan repaid. But you would, on the front end of your loan, you would want to say, this is what I'm prepared to provide as collateral. And then 3 months of your most recent bank statements, your business bank statements, and your personal bank statements. Real quick, a business plan. This is the single most important thing in the startup or in the early business phase. It spells out what your business does, how it does it, where it wants to go, and how it expects to get there. It needs to be concise but relevant. And I say this tongue in cheek, the size of the binder does not determine the creditworthiness of the ask. There are so many times, and I know that Wes and other bankers can attest to this, that you come to us with a 2-inch binder of information, and not everything in there is relevant to what you're doing. And just because it's 2 inches thick, it's not an impressive thing. So when you're putting it together, being concise and relevant is more important than how much information you put together. For instance, if you're buying more equipment, show how that'll impact your sales and your profitability. Here's what I'm using the money for, and here's why it's a good idea for my future business plans. I use this as an example, but if you're selling homemade quilts, it's not relevant what the worldwide market for handmade quilts is. What matters is if you understand what your market is. In speaking about being concise and relevant, understand, I know a lot of people watch Shark Tank and they'll say, oh, I'm doing this and it's a $4.2 billion industry. Well, that's fine, but what is the market here in Spartanburg? What is the market in your neighborhood? What is the target that you're looking for? That's what's important, and that's what you need to know and to be able to share with us. Be focused, include biographies and resumes of your company principals, and include your projections that can be backed up and that they make sense. That's the single most difficult part, is if you come to me with a new business and you say, I'm going to do 5,000 the first month, and then 10, 20, 40, 80, you're going to double every month. That's fine, but show me where that's going to come from and make sure it makes sense. The reason with 2 years of projections is I want you to understand this. They allow the lender the chance to assess your ability to repay the loan, and this underlined part, your understanding of your business going forward. Doing the projections is as much for you as it is for me. You need to know, is this really viable? Do my numbers really make sense? And so they allow you the chance to fully assess your ability to make the loan payments and to see the impact on your business. And again, being realistic and supplying backup. So at the end here, just want to say, if you need help with business plans, there's so many areas, so many people here in the area that can help. The Small Business Development Centers, there's one at the Spartanburg Community College Tiger River campus, and they would be more than happy to set up an appointment with you to help you. Here at Community Works, as of last year, we are now running a women's business center, and you can see their information on here. They'll be more than happy to help you in any way that they can. And also there's something called the Service Corps of Retired Executives, or SCORE. These are retired executives who volunteer their time and more than happy to set up appointments for you to help you with your business plan. And that's basically what I have. There's our social media information. And if you have any questions at the end, be glad to answer them, but always feel free to reach out to us. So thank you very much.
All right. Can you guys hear me now?
Yes.
Yes, we can.
All right. It's not a Zoom meeting without some technical difficulties.
Exactly. Okay, let's see.
All right. And as I was trying to say, apologies if you guys hear some severe weather in the background. That storm has made its way to Charlotte now. So it was going a little nuts here a minute ago. So it's actually probably good that it gave me another minute for this to clear through. As we talked about earlier, my name is Michael Hughes. I am our SBA expert at the bank, at Truist Bank for the Carolinas. I do not work for the SBA directly. So I'd like to point that out because some folks get a little confused there. One thing I will mention as we're talking, through this, each bank has their own kind of policies and credit guidelines that they're going to use within the SBA parameters. So just because it's eligible doesn't mean each bank is willing to lend into that eligibility situation, and each bank has their own appetite. So that's something to consider as we talk through this. Up there is my biography. Feel free to look at it. The most important piece of that is the contact information on the right side. If you need to give me a shout or an email there. And if we'll go to the next slide. So a lot of folks ask, Mike, why is the government in the business of lending to small business? I think that was a more relevant question prior to 2020. I think now people really understand why the government's lending to small business with the PPP funds, the EIDL loans, the different items that are out there. But the real answer here is that and this is a little bit of an older survey, but there's nearly 30 million small businesses in the United States, and of course that's going to count things from your local car dealer all the way down to your person that's selling something like a Mary Kay product, or even if you own a rental property and that's it, you're still considered a small business. So there's some very, very micro businesses in there as well as some larger businesses in that number. But Alan mentioned earlier that these small businesses are like what I like to say Main Street America is the backbone of the U.S. And that's true, and you can see that in these statistics. So the small business sector employs over 99% of our or 99% of the employing firms, and then they're over 50% of the jobs that are out here in the U.S. Those folks generate 1/3 of the exports that we do, and they create over 60% of the jobs and the new job creation numbers that you see coming out constantly. So there's a lot of reason why the government wants to make sure that there's liquidity moving into this segment to help the banks, have a risk appetite to lend to folks that maybe, otherwise wouldn't quite be there, or maybe we're doing just a very aggressive loan structure, which we'll talk about in a few minutes. The reason why the SBA was started, we can go back one slide still. There in the light blue, it was made to help American businesses grow, really, to build those businesses and occasionally start up. And that was started back in 1953. And there's a little bit more data there. And we can go to the next slide. When I'm working with a business, so we look at ourselves, I guess, more as consultants, really. And so when we're talking to small businesses, we are trying to figure out what's the best thing. So we're talking to them about all their future plans, where they've been, where they're headed, where they are today, and really capture that business from where they started to where they're headed. And there's 3 strategies that you'll see deployed whenever you look at an SBA loan. So we may be rebuilding the balance sheet. So maybe rethinking how it's capitalized and, in fact, recapitalizing it in itself. We're going to enhance that company. So that could be by strengthening the balance sheet like we just talked about. Or maybe we're going to do something to enhance profits. So think of vertical integration, buying your supplier, for instance, or buying your distributor if we're going to vertically integrate. And the main thing that you'll see in most SBA loans is the theme of growth. And so that could be organic, where we're providing working capital to help you put feet on the streets to go grow your business. Or we could be helping you buy one of your competitors or another geography through an acquisition. Even at times, we're doing new product lines. So someone may be, in the construction industry right now, and they want to move over and start offering some safety equipment that applies to the construction industry. So that would be a new product for them. One thing I marked through here, I don't know who put it in there, but I left it without marked through it, is add partners. You cannot do partner buy-ins with the SBA. We can do partner buyouts, and we do quite a bit of that, or change of ownership. But as far as adding a partner, we cannot do that. So I've marked through that piece. If we'll go to the next slide, thank you. This is just a little bit of an overview. I would call this your summary slide. So if you want to go back and reference anything specifically, this is it. Okay, so there's the 7A program, which is probably the most common and what you hear about the most this day and age. At one time it was the 504. But that loan program goes up to $5 million in revenue, and it has a flexible use of proceeds. The 504 that I was talked about, and I'll touch on these in a little more depth in a minute. The 504 is really for fixed asset purchase or construction. So that would be buying or building a building or very large equipment. And then there's also an express, SBA Express, which oftentimes is deployed as a line of credit. So you'll hear it called an SBA Express line of credit. Not always, but frequently. The things on the right side, Wes talked about a lot of things on the conventional side of lending. And what I'll tell you is that on the SBA side, it's not that much different. We're looking for very similar items. So the adjusted size standard is, how big of a business can we lend to? And a lot of folks think my business is too big for SBA. And a lot of times that's because some banker told them that, to be frankly. But the reality is up to 15 million in tangible net worth and $5 million in after-tax profits is the limit. So you have to hit both of those. If you don't hit both, then you can actually still borrow from the SBA or from the bank via SBA funds. So that's a pretty large business. Now that also goes all the way down to startups and micro businesses as well. But that's the kind of the cap. I've only looked at one business in my entire career that disqualified themselves based on size standards. We are looking for generally historical cash flow. So we generally look at West said a 125. We're generally looking at least a 115 business debt service coverage. In fact, the SBA requires that. That's part of the SOP. And at times, maybe we're looking at an expansion. And so maybe your favorite restaurant down the street is growing into another location across town. And in those instances, we're going to look at projected cash flow, which Paul touched on a few minutes ago. When you see that, though, you still want to see that the historical ability to cover debts there. So we talked about second sources of repayment earlier. Generally, that would be the first restaurant. So you'd want to see like a 1-to-1 coverage there before you lend for the second location. And then basically, all those projections are just gravy, and you hope they're making those projections. If we're looking at something that is more or less a startup or a change of ownership where you're going out and buying a business, we are looking for industry experience. It says transferable because that's the word the SBA uses. But what I can tell you is the higher risk the industry or the higher risk the profile, they're looking for direct industry experience. The lower risk the industry, they're going to start looking towards what we call transferable or translatable industry experience. We are looking for businesses where the principals are actively involved. So occasionally I have someone, maybe let's call it Pennsylvania, calls me and says, Mike, I want to buy a company in South Carolina. We may be able to facilitate that transaction, but as Paul talked about earlier, being really able to iterate how you're going to do something and how this is going to be successful, that's the next question I'm going to ask when you're in Pennsylvania wanting to run a business in South Carolina is, are you moving? If not, how are you going to run this? And we've done a few where folks were, kind of remote owners, so to speak, but they were actively involved day to day. Think about like network installation businesses or something that are really high tech, and they're going to have remote employees anyway. And so in that case, maybe your location isn't as dependent. But if you're going to be a manufacturer or an assisted facility owner, assisted living facility owner, you need to be there day in and day out. So we need to really understand that. So we are looking for actively involved principals. Credit is the SBA is not going to fix bad credit. Okay, so if your credit has been dinged, that's something you want to go correct. Look at how to fix that for yourself. Even loans that 350 or under, SBA has its own credit scoring system, and they'll look at it that way. But we also look at personal credit as well as business credit in various forms, depending on loan size. We are looking for post-closing liquidity. This is something I see a lot with requests because SBA does have lower equity injections. So frequently, borrowers will come and let's say, sake of round numbers, they want to buy a $500,000 building, and generally we require 10% down. So when we're requiring 10% down, if all you have is the $50,000 on the $500,000 building, and so when I close that loan, you have no post-closing liquidity, that's probably not a loan that we're going to close for you, both from a prudent lending perspective, but also we're advisors and we're here to help you, and we don't want to put you in a position where a cash hiccup the next month is going to put you on tough times. So we do want to see the ability to be able to have good cash positions after closing. The other piece with SBA that you'll see, Wes earlier talked about, maybe non-recourse loans or unguaranteed type loans. That's not going to happen on the SBA world generally. Anybody who owns 20% or more of that business will be required to guarantee the loan personally. Also, we go upside down a lot, so loan to value is not as important on 7As. But if we do go upside down on loan to value, meaning that we've financed over 90 or over 100% of the transaction, we will look to see if there's other collateral available on the personal financial statement. So that could be commercial real estate or residential real estate. We don't tend to look at stock portfolios or anything of that nature as collateral. Those are kind of fall into the cash cushion buckets. And then you need to be a U.S. citizen if you want to borrow from the SBA, at least 51% ownership, or a permanent resident alien. So if you have a green card, that's also okay. Visa holders can't really borrow from the SBA. There was a time where they can, but they've made some changes in the last SOP. It makes it a little tougher to do that. So if your business is owned by a foreign parent, unfortunately, we won't be able to lend to you under the SBA program. Just a couple myths. A lot of folks feel like when they're talking about SBA that they're going to be working with the government. In fact, you're really going to be working with the bank, and that bank has a government program. So you're not going to work directly with the government unless you end up into an actual default scenario, and that would be way down the road because you still work with the bank even through default, all the way until when we sell the loan to the government. The loan process being slow, that's also a misnomer. A lot of times it has to do with your bank if they're being very slow. Now, we'll throw a caveat in there that during PPP right now and all the volume going to the SBA shop, everybody's slow. So we are a little slower than normal. But on a typical day, in a typical time, 45 to 60 days is pretty common for an SBA closing. So really not much different than your conventional channels, maybe a week or two, just depending on a few items. So that's a little bit about that. If we go to the next slide, I'll dive a little deeper into each one of these programs. So the 7A I mentioned a minute ago, it's multiple use of proceeds, $5 million kind of cap on that. The pricing can be up to prime plus 275. SBA, and what's my time? Because I got off a little bit, guys. I want to make sure I'm not tracking over.
Yeah, I probably have about 5 more minutes.
Okay, thank you. All right, so the SBA 7A, again, most popular program you're going to see out there right now. Most of the other SBA programs that you hear about fall under the 7A. So the Express and the Community Advantage are part of the 7A program. They're just subsets. But the loan amounts are up to $5 million for the 7A program overall. Pricing is prime plus 275 variably. Now, banks can reduce that as much as they would like. And then additionally, banks can fix that if they don't sell it. Well, if they do sell it, they can fix it too. But generally, if you're getting a variable rate, that bank's selling that loan. The terms up to 25 years on real estate. And then generally anything besides real estate. So equipment, working capital, changes of ownership are all going to be on a 10-year term. The caveat on equipment is that we can actually go all the way up to 15 years. The new SOP limits us at 15 years. But we can go up to 15 years on equipment if the useful life of that equipment is at least 15 years long. The down payment requirements, so the SBA doesn't actually tell us, except for in the case of a startup and a business acquisition, what the down payment requirements are. But under prudent lending guidelines, everybody pretty much assumes it's at least 10%. So 10% is what you're going to see most of the time. Startups are required to inject at least 10% of the project cost, and change of ownership. If you're buying a company, you're required to put 10% of the startup cost into that. Changes of ownership between partners can be 100% financeable. We do a lot of that here at Truist, but that's going to be dependent on the financials. If your financials show that you don't have equity or you haven't been there for 2 years, then you'll be putting 10% of the purchase price in that case down. So, but again, you hear me talking about changes of ownership and startups and various things. So the equity is part of it, but also the loan to value there is going to be upside down. So those are those situations where I might lend $2 million for a partner buyout, but we don't have $2 million in what we consider to be collateral. And the SBA says that's okay, as long as you took all available collateral. So that's how we shore up collateral shortfalls, is with the guarantee from the SBA program, which is the next little piece written there. 75% guarantee is common. Right now it's 90% through the end of the year. Up to about 4.2 million, then it starts to kind of come back down. But for all intents and purposes, it's up to 90% right now through, if I said the end of the year, I meant SBA's end of the year, September 30th. Flexible uses of proceeds, so I can finance real estate, goodwill, working capital, equipment, and acquisition. I can do all that in one loan. So that's a little different than you would see conventionally. If you were to finance those different categories, those would be different loans in each one. I've done loans that have up to 7 uses of proceeds all at once. The benefit of that is that you're gonna have better cash flow. As you start to split these up, the terms of the loans change, and it's going to degrade your cash flow. So that's why we're able to do that. Talked about collateral shortfalls, fees. So there are fees with SBA loans. Before we moved into the PPP loans, SBA was a zero subsidy program. So the people who use the program actually paid for it. So that would, just like health insurance, everybody pays in, and those who get sick get covered, and those who don't, they get the benefit of the program. So which is still lesser down, longer term financing. So that's that piece. Don't be surprised by the fees. Generally, what I tell folks is these loans are very custom built solutions. If that fee really hurts you or matters to you, then the banker you're working with didn't build you a very good solution. Generally, you should have enough internal return to make up for the way we structured the loan versus your fees and your interest rate. And then there can be prepayments on 7As if they're longer than 15 years. It's a 3-5-1. I don't really consider it to be a prepayment penalty because most folks aren't really going to pay it off that quickly. So I'm going to breeze through the next couple of slides. The 504, that's a fixed asset purchase. We do a lot of those as well. It's a piggyback loan structure. It gives you long-term financing with a lower long-term financing, long-term rate, lower down payment. We can talk about that, but the program is very similar to the 7A outside of the fact that they can only finance real estate and fixed asset purchases, so large equipment. There's another slide on the Express right below that, which you can read through as well. The Express, I will touch on, they have extended that up to $1 million for the interim period. That will go back down. I think that now it's permanently up to 500,000, so it'll go from $1 million to 500,000. I believe it's either September or the end of the year. And currently, loans under 350 are up to 90% guarantee, and everything else is 50%. But generally, banks use an Express as a line of credit, as I mentioned, 2-year revolver, 5-year term out. That's kind of a line of credit with training wheels. So once you get into the 2-year mark, you can refinance that conventionally, generally into a conventional line of credit. If you can't, or if it's non-revolving, then it's going to go onto a term out. So that's why we use that structure. And then the last slide I'll touch on, right below this one, is some industries to think through. So the yellow ones, we require higher due diligence. We do them at times. If you have an environmentally distressed property, we at our bank will probably not look at that one. But ground leases, I'm looking at one of those right now. Startup businesses, ESOPs are really hard to lend to. We do lend to ESOPs as well. Restaurants, we do a fair amount of. But each one of these have their own nuances. So just be prepared for more due diligence if you're in one of these yellow categories. Green is where everybody wants to lend. And then the red side, not-for-profits do not qualify for SBA. If you're lending money yourself, you don't qualify for SBA. But take a perusal through that when you have a few minutes. But I do want to yield my time, so to speak, so that we can have some Q&A.
Great. Thank you, Michael, Paul, and Wes for the great information and great content. If you need dollars, there's a lot of options for you. So do want to ask you any questions. I don't have any in the chat. Does anybody on the call need any clarification on any of the topics that were discussed today? I know there's a lot of it. If any questions or comments from the audience? You can just chime in, take off mute if you have a question, or you can just put it in the chat if you have some. Again, these will be recorded. They'll be on our website. They'll be on our social media channels after the session today. But any questions? Great. Well, I don't have any questions from the audience panelists. Yes, Christy Brown did say, yeah, we will. All this information will come to a link info to your email if you register for today, and also on other channels as well. So, well, Wes, Paul, Michael, thank you for your time today, and thank you most importantly for all the great information that you provided to us today.